Most portfolio videos focus on individual ETFs, but that's not actually how I think about portfolio construction. Instead, I build a portfolio in layers, or what I call sleeves. Each sleeve has a very specific purpose. One sleeve focuses on long-term growth. Another sleeve focuses on generating income. And together they form a portfolio that is designed to support retirement while still allowing the portfolio to grow. In this video, I want to walk through how this works in my own portfolio. One quick note before we start. The ETFs I'm using are UCITS ETFs, which are typically available to investors in Europe and Singapore, but not to US investors because of regulatory differences. Also, to make the numbers easier to understand, I'll assume a $1 million portfolio. The percentages are what really matters, not the invested amount. And one more important clarification, what I'm showing here is only the investment portfolio itself. Separately from this portfolio, I maintain a much larger cash reserve, which currently covers roughly 1 year of living expenses if needed. So this portfolio is designed for long-term investing, not for short-term emergencies. And finally, I still have a job today. So the portfolio you're seeing reflects the structure I use while I'm still working. When I eventually transition into retirement, the allocation will most likely change, and I'll explain what that might look like later in this video. The portfolio is divided into 3 main sleeves: growth, income, and a small amount of cash. The target structure looks like this: growth about 49%, income about 49%, and cash around 2%. The idea is very simple. The growth sleeve grows the portfolio over time. The income sleeve generates regular income that can be used during retirement. And the cash sleeve provides liquidity and stability. Let's start with the growth sleeve. The growth sleeve is built around global equity markets. The main ETF here is VWRA. This ETF tracks thousands of companies across developed and emerging markets. So by holding VWRA, you essentially own a small piece of the global economy. In the portfolio, it represents roughly 40%. Then there is EIMI, which focuses specifically on emerging markets. Countries like India, China, Brazil, and others that still have higher long-term growth potential. That adds another 5%. Together, this sleeve represents roughly 45 to 50% of the portfolio. If we assume a $1 million portfolio, that means roughly $450,000 to $500,000 invested in global equities. Historically, global stock markets have delivered around 6 to 8% annual returns over long periods. Of course, markets move up and down, but this sleeve provides the long-term growth engine of the portfolio. The income sleeve has a very different purpose. It is designed to generate regular income. This sleeve combines several types of income-producing assets. First, there are investment-grade bonds through the ETF CORP. These are bonds issued by financially strong companies, and they form a stable core of the income sleeve. Then there are high-yield bonds through IHYG and IEAG. These bonds offer higher yields, but also carry somewhat higher risk. Next, we have emerging markets bonds through IEMB, which adds geographic diversification and currently relatively attractive yields. Then there are dividend-focused equity ETFs, specifically IAPD and SEDY. These invest in companies that pay strong and consistent dividends. And finally, there are global real estate ETFs such as IPRP and IWDP, which provide exposure to real estate income. Altogether, this sleeve represents roughly half of the portfolio. On a $1 million portfolio, that means about $490,000 invested in income-producing assets. Based on current yields, this sleeve generates roughly $20,000 to $30,000 per year in income. That income can either be reinvested while working or eventually used to support living expenses during retirement. There is also a small hedge position in gold through the ETF IAU. This is only about 1% of the portfolio. Gold doesn't produce income, but it can act as a stabilizer during periods of financial stress. And finally, there is around 2% cash inside the portfolio. But again, this is separate from the larger personal cash reserve I maintain outside the portfolio. Right now, the structure reflects the fact that I'm still working. Because of that, the portfolio can remain relatively balanced between growth and income. But once I eventually transition into retirement, a few things will likely change. First, the income sleeve will probably increase. The reason is simple. When the salary disappears, the portfolio has to take over more of the income generation. So the allocation might shift slightly more towards income-producing assets such as bonds, dividend stocks, and real estate. Second, the cash buffer inside the portfolio would likely increase. Retirees often keep a larger cash reserve to avoid selling assets during market downturns. And third, the withdrawal strategy becomes important. Instead of reinvesting dividends, the income sleeve would begin to support living expenses. But the key idea remains the same. Part of the portfolio continues to grow for the future, while another part provides stable income today. If we step back and look at the entire structure, the logic becomes quite simple. Roughly half of the portfolio is invested in global equities designed to grow over time. The other half is invested in income-producing assets designed to generate regular cash flow. Together, this creates a portfolio that can potentially provide around $20,000 to $30,000 per year in income on a $1 million portfolio, while still maintaining long-term growth potential. Of course, the exact numbers depend on market conditions, but the structure itself is designed to be stable and diversified across asset classes, regions, and currencies. In the next few videos, I want to go deeper into the individual parts of this portfolio, starting with the growth sleeve and why global index investing plays such a central role in my strategy. Because building a retirement portfolio isn't just about picking funds. It's about designing a system that can support you financially for decades. And that's exactly what I'm trying to build here. If you're in a similar situation, feel free to subscribe to the journey. And see you in the next video.